I want to bring in Gene Munster, the managing partner at Loup Ventures, who's on the phone. We're going to do some trading with Tom White here in studio in just a sec. Gene, thanks for dialing in. So everybody's going nuts after this report. Tell me why it's such a big deal.
Well, Oliver, the demand side of the equation had been reported a few weeks ago, and they had suggested that the overall vehicle deliveries are going to be up 16% year over year, which essentially was in line with expectations. But Elon Musk had tweeted that they would do 100,000, so that stock actually traded off on that a few weeks ago. So what's changed here is that the profitability equation really strengthens their case for long-term sustainability. I just kind of want to quickly get to the core number. The most critical number is automotive gross margins. And the best way to think about auto gross margin is to back out what they call ZEV credits. These are zero emission credits that they can sell back. That really, ex-ZEV credits really is their core profitability, the core gross margin on their vehicles, which is a leading indicator to their cash flow longer term and their sustainability. And so that number was 20% compared to 16.9%. So call last quarter. So call it was up 3% sequentially. But analysts had expected that number to dip slightly sequentially. In actuality, it had improved mostly because of just operating efficiencies, but they're also starting to recognize some of this higher margin revenue from their full self-driving feature. And so the most simple way to think about this is the stock is up because their ability to be around for a long time improved last night.
So I like the way you put this, Gene, and it's the first thing in your note, which is what I think is really telling, is the software basically being that margin enhancer and that kind of lifeline to help the bottom line. Is that why the EPS beat so big in your mind?
Well, that was a part of it. When the numbers first came out, we thought that was half, a third of that beat. In reality, it was probably, if you look at it, was called a $300 million beat. 30 of that $300 million, so 10% of that, came from them recognizing this virtually 100% margin software revenue. And so that number, they still have, call it $500 million in deferred revenue that they can recognize over the last few quarters. Again, they recognized $30 million last quarter. That $500 million base grows every quarter because they sell new vehicles that have this, call it 8% attach rate of the full self-driving, which they charge $6,000 for. So this is a critical part of the story that I think will slowly become more central to how investors think about the Tesla story. And essentially, it's the business model is slowly shifting to higher margin software. This is the only automotive company that does this. They're the only automotive company that's recognizing any sort of enhanced driving features on a software basis. They're the only ones that do deliveries over the air. Because the dealer network wants you have to bring your car in to get it serviced for most car manufacturers. So what this ultimately means is they have essentially this war chest of high profitable deferred revenue that they can recognize and continue to move profitability higher. And as someone who's betting against this, I'm not betting for or against it. I'm just trying to be middle of the road here. Mm-hmm. Someone who is betting against this story, that would be an intimidating X factor, that their ability to basically recognize this high margin revenue at any time over the next year.
Now, how come, Gene, I don't hear more about this elsewhere? I mean, talk with a lot of Tesla analysts, and most of the time it is about the delivery numbers, about the auto sales, the mix between the lower and the higher price. But it sounds like this is a really important core part of your thesis. So I want to stick with it for a sec as everybody looks at the numbers. We're going to talk later on the show, too, for viewers about some of the hardcore car numbers here. But, Gene, where does this go? Are you able, though, to figure out their growth for this part of the business? Are you able to figure out the kind of trajectory or the addressable market?
Yeah, you can. And essentially, we can back into some of the attach rates, percentage of Teslas that are sold that people upgrade to that $6,000. I mentioned that 20% number. I think the attach rates currently are closer to 40%, really high attach rate. But you can argue over time that it might slow a little bit as this becomes more mainstream. I think the reason why people aren't as focused on it today is, first, it was a small part of the story in the most reported quarter. I talked about 10% of the upside was related to it. but also there is this, for the broader community, this is still viewed as a car company, and understand why. And I think this concept of them having hardware out there where they can find other ways to sell advanced features, that is so nascent that it just takes time for these movements for people to gain visibility on it. Most analysts would just look at currently Tesla's market cap is essentially the same as Ford, Honda, GM, Uber. It's all kind of in that same mid-$50 billion number. And I think that it needs to kind of break out from that for this new view to take a hold, which is that this is slowly going to become more of a software play.
Yeah. Gene, lastly, is expectations that you now have based on this number. How does your view about Tesla's future change in terms of how much you want to own, price target, et cetera?
Well, it's improved. I think at the end of the day, we don't have price targets, but I do believe that there is, for an investor who has the luxury of owning something for 1 to 4 years, this is I think should be a core holding. I still believe Apple over the next year has more upside, but I think if you think about a story that over the next several years, I think this is a great one to own. Will be controversial over the next few quarters, undoubtedly, probably for the next few years, but I think that they have made a measurable step in the right direction for their sustainability.
All right, Gene, good as always. Thank you, sir. Gene Munster, managing partner at Loup Ventures. Tom White in studio. All right, so let's trade this thing to the upside. How do you look at it after the big move?
Well, if you're more neutral to bullish on some name like this, Tesla, I like to trade the option just because I could stay risk defined. It's a $300 stock. There's a lot of risk in it just buying the shares. But if you look at the option market, there's ways to play it. So the first one I wanted to look at was selling a put spread in there, which takes advantage of that neutral to bullish stance, but it gives you a nice cushion to the downside. So what I did was I went out to the December 6th weekly series, so about 43 days until expiration, so just over a month. And what I did was I looked at selling the 265, 260 put vertical, $5 wide. You collect roughly about $1.10 credit, depending on where the stock is right now. And that makes your risk about $3.90. So basically, not a great risk reward, but at the same time, you still have about $35 down to the downside before you start getting into trouble on this type of trade. And it's a longer term type of put spread than I would normally do, but I want to give myself a little bit more time in case the stock does pull back. We might set a new, a new area or range-bound trade, because that's what Tesla seems to do. Every few months it stays in a specific range.
Yeah, it makes a big move and then kind of sticks around there until the next big move.
Right, so I wanted to give myself about $35 to the downside. Good probability of that 265 short being out of the money at expiration, and that's what you want. And if you're not comfortable owning those shares, if it does pull back below 265, you can always close it ahead of expiration to get out of that. And then I also looked at a neutral strategy in here. To Gene's point, a lot of people don't know where this thing is going to go. There's a lot of price targets out there from...
Short squeeze 2, probably a part of this.
That's probably part of it. But what I did was I created another trade just in the November series, so about 22 days to expiration. Volatility is still elevated, even though we got the vol crush after earnings, but I wanted to do look at a more range bound. And I skewed this a little bit, Oliver, to the downside. I don't want that much downside risk in case this thing does pull back. Maybe after this massive rally, I want to be a little bit tighter on the downside. So I sold the 270, 265 put vertical to the downside, so that's only $2.50 wide. But then I sold the 330, 335 call spread, so $5 wide. So you see the risk there is a little bit, a lot higher on the upside, but I'm still risk defined on both sides. You collect roughly about $1.10 credit on this iron condor, short iron condor, so it's 2 short verticals, out of the money on the call side, out of the money on the put side. You see the break evens there, 268.90 and 331.10 on the upside. So nice wide range for this stock to kind of consolidate in near this 300 level over the next 3 weeks, Oliver. But then you actually take advantage of time decay or theta in this type of position. But I think the key with Tesla on any type of trade that an investor might want to do is to stay risk defined in this because we all know, and you saw it post earnings, almost a 2 standard deviation move, or was a 2 standard deviation move. So this thing can rip at any point based on headline news and fundamental news.
All right, we're going to follow up and talk more about what happened on the vehicles and what it means that they've got production coming out of China now. We're going to hit that in a little bit on hour 2. But first, let's take a short break. Thanks to Tom White and Gene Munster, of course.